The Japanese yen just plummeted to a 40-year low, and while it's crushing regular citizens, a massive anomaly is happening in the stock market. Some investors are about to make a fortune. Why is the real economy bleeding while certain stocks are set to skyrocket? The answer lies in a hidden economic turning point that the central bank doesn't want you to panic about. And if you know where to look, it completely changes how you should invest right now. Now, let's dive into exactly what's happening. On June 30th, the Japanese yen plunged to its lowest level since 1986, with the US dollar breaching the 162 yen mark. For the real economy, skyrocketing living and operational costs are undoubtedly piling immense pressure on citizens and businesses alike. However, the stock market tells a completely different story. Driven by policies designed to counter a weak currency, certain stocks are actually poised to benefit, creating a stark divergence between the financial markets and the real economy. So why is the yen depreciating so rapidly? There are both long-term and short-term factors at play. Looking at the long-term causes, there are two main drivers. First, even though Japanese interest rates have been steadily climbing over the past 5 years, they remain significantly lower than the US dollar and other major international assets. This massive gap fuels carry trades, keeping relentless selling pressure on the yen. Second, Japan's national debt has been stubbornly high for years, with its debt-to-GDP ratio soaring past 200%. This staggering figure continues to weigh heavily on the yen's long-term value.
As for the short-term catalyst, look no further than the geopolitical tensions that have driven energy prices through the roof. Japan relies heavily on imports for its energy supply, getting over 95% of its crude oil from the Middle East. When oil prices skyrocketed, Japan was forced to sell massive amounts of yen to buy the US dollars needed to pay for this expensive oil, creating an immediate and intense selling pressure on its currency. Donald Trump has previously accused the Japanese government of intentionally weakening the yen to gain an unfair advantage in international trade. Combined with domestic inflation, Japan is facing pressure from both home and abroad, making action to defend the yen absolutely vital. The Japanese government has repeatedly intervened in the foreign exchange market to stabilize the currency. However, the public rarely finds out in real time. Instead, these interventions are officially disclosed at the end of each month by the Financial Services Agency, a strategy designed to minimize speculative volatility. But while these operations can temporarily adjust the exchange rate, they cannot reverse the long-term trend, because the underlying fundamentals of the yen remain unchanged. To truly fix the problem, rather than just treating the symptoms, the fastest cure is to raise Japan's policy interest rate to narrow the yield gap with other currencies. This is the quickest tool to execute, faces the least political resistance, and can fundamentally drive the yen's appreciation. Predicting Japanese interest rates using pure data is incredibly difficult. In economics, interest rates are considered an exogenous variable, meaning they are influenced by outside factors that are hard to quantify mathematically. Therefore, to forecast where rates are heading, experts generally rely on textual analysis of central bank statements. Given that the Bank of Japan explicitly stated at the end of last month that interest rates will continue to rise, we now have a highly reliable indicator that rate hikes are on the horizon. From an investment perspective, rising Japanese interest rates will be a massive tailwind for Japanese financial stocks. These beneficiaries can be broadly categorized into banking stocks and insurance stocks. Banking stocks are highly sensitive to interest rates and stand to benefit the most. As interest rates rise, banks enjoy wider net interest margins, which directly boosts their profitability and drives up their valuations. On the other hand, higher interest rates allow insurance companies to generate better returns on their massive investment portfolios, pushing earnings higher and exerting a positive impact on their stock prices. In fact, data over the past 5 years clearly validates this trend. Both the Topix Banks Index and the Topix 17 Financials X Banks Index, which has a high concentration of insurance companies, have moved in tandem with rising Japanese policy rates. While a weak yen strains daily life and business operations, the shifting tide toward higher interest rates is unlocking unique opportunities in the stock market. For investors looking ahead, Japanese financial stocks, especially banks and insurers, are the key sectors to watch as Japan navigates this economic turning point. Understanding the market is just step one. If you want to transform this insight into actual earnings, make sure to subscribe. We have a lot more investment strategies and personal finance tips coming your way. See you in the next video.